5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to this week's edition of Follow the Money Weekly Radio. So glad that you're joining us all around the world. You can find us online at followthemoney.com. Followthemoney.com will take you right there. Lots of free podcasts, reports, videos, all kinds of things we've done over the years. You can also find us on social media when you come to our website. Those of you on Facebook and Twitter and on YouTube and all of those other great sites. We are out there as well. So hopefully we can connect with you online. All right, friends. Well, listen, we got a great program today lined up for you. We're going to be joined by Marc Faber, very famous investor. He's a Swiss investor, in fact, based in Thailand. He'll be joining us from his Thailand office today in the discussion. He's the publisher of the Gloom, Boom, and Doom Report, which is a newsletter. He's also the director of Marc Faber Limited, which acts as an investment advisor and a fund manager. We'll be looking forward to our discussion with Mr. Faber. He'll be talking about precious metals, agriculture, commodities, and energy. All those are areas that he sees doing well, at least in 2017, but perhaps just generally underneath a Trump administration. For all of our members, we just released at the beginning of the year the top 10 stocks for 2017 that we like. One of them, in particular, in the uranium space, which has really been exploding higher over the last several weeks as supplies have been coming down, as producers just simply can't produce at these low levels. Therefore, we've seen a overall price bounce in the price of uranium, and this, of course, has helped miners. We just put out a weekend briefing for all of our members, providing some guidance on this new uptrend that we see in uranium with just some general thoughts, and so all of our members can certainly check that out. By the way, solar power, solar energy, now the cheapest form of energy, now that oil prices and natural gas prices have been lifting off, leaving solar power now as the world's cheapest source of energy. And of course, anytime you have that kind of cycle in prices, that tends to lead to a rebound. So later this month, we're also going to be releasing for all of our members our 7 favorite solar energy stocks for 2017. We think that solar energy could possibly see a nice renaissance in 2017. And we'll go into some of the details in that report. But if you like solar energy and you don't want to miss that run, be sure to become a member, because we're going to be blasting that report out to all of our paid members. Okay, so let me see here what I wanted to talk about. I have a few notes here before we bring Mr. Faber on, and I really want to talk to you about, of course, a couple of things. One is that President-elect Trump is going to, of course, be inaugurated this week. It's a big, big week. On Friday, of course, will be the day that he actually is sworn into office, and he will fully replace President Obama as the 45th president of the United States. And as this prepares to take place, I mean, there are all kinds of subjects that we could focus on. The geopolitical tensions, of course, perhaps issues with China, trade wars, concerns about where the market's going to go, what's going to happen to gold, what's going to happen to the dollar underneath a Trump administration. These are all questions that market commentators are speculating about today. But I tell you what, what's really interesting to hear is the sudden political shift. And we hinted at this in our last broadcast, but you're beginning to see this thawing of fear that had really taken hold in the 2008 economic crisis. There was never any trust in the Obama administration within the GOP, many people who are Republicans who, obviously have pulled their money from the stock market. There has not been any trust of the stock market underneath President Obama. And I would say largely that trust, or that mistrust, was on the right side of the political aisle. And this is what happens when you trade according to your political ideals. I mean, over the last 8 years, underneath President Obama, Since he took office on January 20th of 2009, the stock market has exploded higher by more than 175%. If you just take a look at the S&P 500, 175% returns over the last 8 years underneath President Obama. That works out to an astonishing average gain of about 22% per year underneath President Obama. Now, the critics are quick to point out that these huge gains in the equity markets would have failed to materialize without unprecedented doses of monetary stimulus, along with crafty financial engineering techniques like corporate buybacks and other clever accounting tricks. And here the critics would be right. However, being correct about the underlying causes of one of the most hated stock market rallies in U.S. history doesn't put any money in your pocket. Many investors, and I would say too many, sidestepped the epic stock market rally out of the last 8 years due to political angst and fear of President Obama's policies. And now, with the stock market up nearly 180%, the S&P 500, now we're beginning to get hints from GOP market commentators that the uptrend is going to continue. And so now that we have had this gargantuan run in the stock market, and for all we know, we could be at a top here, suddenly GOP investors are saying, hey, let's loosen up the kitty here. Let's go ahead and put in some money into the stock market because, hey, it's got to go up underneath this new sheriff that's in town. Now, can we predict which way the stock market is going to go? No one can, right? If anyone can predict which way the stock market will go, then they, of course, will quickly be very financially independent and will obviously be able to sell their predictions forever and make all kinds of money. That's not happening. People can't tell you what the weather is going to do tomorrow. Weathermen can't get the weather right. Stock market prognosticators can't get the market right. The fact is that you and I, friends, cannot predict where the stock market is going to go. We can only follow the trend or follow the money. And for the last 8 years, we have been following the money higher with a couple of exceptions. In 2011, we got spooked because the market really sold off on huge volume. And so we sidestepped the market temporarily. And then we got back in and then rode it all the way up until 2016. Now, things in 2016 got weird too. 2015 and 2016 were very strange years in the market, but now we're beginning to ascend even higher now that President-elect Trump is now preparing to take office. And what is the stock market going to do once he takes office? Is it going to rise? Is it going to fall? Well, there's no shortage of opinions, right? Opinions are everywhere. You can buy an opinion for a nickel. I mean, everybody will sell you their opinion. But what's really going to happen? Well, all we can do is watch the price and the volume of the market to understand what might be in store. And one thing that we are at least positive on and feel strongly about is the fact that we are beginning to see some volume come into the markets. Now, here's one of the things that you've got to know, that over this last 8 years of this incredible rise in the stock market, and even though it was all artificially engineered, even though it was all due to smoke and mirrors, much of it, not all, there was some genuine growth going on in many of these companies. But overall, the economic situation here in the United States for the average individual out there working, things are not really that much better over the last several years. The way that the stock market has exploded, you would expect that the economy would have followed suit. But that's not the case. That's not the case. And if you look at the U.S. financial system today, you'll discover that it is controlled and dominated by 6 multinational banks, just like the U.S. media, controlled by 5 or 6 multinational corporations. That's right, 3/4 of the U.S. financial system is controlled and dominated by 6 multinational banks with trillions of dollars of assets. These banks are larger than many countries. And worst of all, many of these too big to fail banks are now 40 to 50% larger than they were prior to the crisis of 2008. So it's only reasonable, it's only natural to expect another market bust. Artificially low interest rates have greatly distorted the global financial markets and basic economic incentives. And these things are dangerous to tamper with, and yet that's exactly what the Fed has been doing. They've been specializing in tampering with the monetary system for the last several decades. And when we take a look at the future, the only solution to our economic problems lies in a restructuring of our systems to make them more sustainable, to make them more realistic. You can't always have low interest rates, low taxes, and high amounts of government transfers and subsidies and benefits. It just simply is not going to continue to be sustainable. So while we believe that Trump will be positive for the optimism in the market, we also believe that he will not be able to, by himself, exert enough pressure to drive the stock market up without other help, whether it be monetary stimulus or fiscal stimulus. But we do not expect him to overhaul or restructure our debt-based systems so that they remain sustainable. Therefore, we do believe that underneath Trump, even though the market may go higher, we do not believe that he will solve the fundamental problems with the economy. Instead, we believe that his debt-based solutions will likely aggravate our problems even greater, to a greater extent. But that doesn't mean the stock market won't go up during that time. We think personally that underneath President Trump, we're going to see gold and silver be beneficiaries, of course. We believe that many stocks, maybe not all sectors, but certainly this will be a stock picker's market. We believe that certain stocks, certain sectors, if you're in the right sectors and the right stocks, that you could really do well underneath a President Trump. And we can all guess as to what those sectors and what those stocks will be now, but the proof is in the pudding. And that's why we monitor the markets. That's why we monitor the stocks and the stock market, both here in the United States and overseas, because we're always looking for that next uptrend. I mean, there really is an uptrend somewhere all the time, right? There's always a new uptrend somewhere. Even if that uptrend is simply in an inverse ETF that's going up because everything else is going down, right? There's always an uptrend somewhere. So the financial system underneath Trump, we're just going to have to keep our eyes on it. But here's one thing we do know is that the volume has been dissipating for many, many years underneath President Obama's stock market rally this last 8 years. So we know that volume is dissipating. We need more volume in order to sustain this massive uptrend. So we'll see whether President Trump's policies will drive more volume, more buying interest into stocks. And if it does, then we could be in for a very big rally across the board in the stock market, at least in the near term. So in addition to the banking issues that we also have the media issue. I just told you 75% of the U.S. financial system is controlled by 6 multinational banks. Right? That's just wrong. It just seems wrong. And they're all too big to fail. So we have to continue to bail them out. All of us, right? Whether that be through bail-ins or whatever they end up doing, these banks, these mammoth zombie banks that have been resurrected from the dead, so to speak, through all kinds of financial engineering and monetary wizardry, will continue to hobble along, and especially if regulations are taken away, many of these banks will do exceedingly well in such an environment. So in addition to the banks and the banking issue, we also have the media issue, this fake news issue that we've been hearing so much about. The phrase fake news is being pushed in the mainstream press, and it somehow distracts us, I believe, from the fact that the mainstream press is largely fake news, right? It's largely fake news. In fact, one can easily be driven slowly insane by subjecting themselves to the constant and daily regimen of corporate media. For example, through the television, corporations are given direct access to your eyeballs, to your brains, to your emotions. Through the TV and other media, corporations seek to shape and mold and fashion our tastes and preferences to suit their offerings. The more that we become like what we see portrayed on television, the more we become the perfect consumer, envisioned in corporate boardrooms and focus groups to drive their stock prices higher by manipulating our emotions and by manipulating our lifestyles. But the corrupt corporate-controlled media was exposed for the fraud that it is in the circus that was the 2016 election. They lined up for Hillary just like 10 out of 11 leading global arms manufacturers also lined up behind her, and Wall Street lined up behind her. The Democratic National Committee itself was exposed for its covert attempts at derailing the Bernie Sanders campaign. And of course, they blamed Russia, who is getting most of the blame for everything today. The media is used by propagandists to push whatever the power players need or want at the time. The corporate-controlled media has promoted every war in U.S. history. It promoted the Iraq and Afghanistan war. It promoted the war in Libya, which has been called the cork in the African bottle that led to the current migrant crisis. The mainstream media is fake news. It's fake news. They take their money from corporations and then they turn around and tell you what the corporations want you to know. It's no secret. It's no secret. We live in a day and an age where we don't know what to believe. We don't know who to trust. We don't know where to turn. In such an era, the only thing that you and I can do as wise stewards of our money is pay close attention as to what's actually happening. Not what's being said, not what's being offered, not what's being promoted, not what's being pumped, but what's actually happening. And where can we find that if we're investors? We can find that on a simple chart. We can see price and we can see volume. Human nature doesn't change, and neither do the corrupt practices and plans of the global elites. Because of this, we remain locked in a boom-bust cycle that never ends. If you learn to play the trends in such an era like ours, there is a lot of money to be made. But those who put stock in opinions and sales hype will soon be parted with their money. All right, well, joining us on the line today is our good friend Marc Faber, editor and publisher of the Gloom, Boom, and Doom report. He's joining us from his office in Thailand. Marc, great to have you on the program today. Thanks for joining us.
My pleasure.
Great to have you. Well, here we are. We're just a few days away from the Trump inauguration, and many people are scratching their heads wondering if all of the fear that we have witnessed underneath the Obama administration is now giving way to this optimism that we see around Trump. Tell us your thoughts on what you see. Has anything fundamentally changed in your outlook with Trump now entering into the office?
Well, we have to distinguish between the economy and obviously the performance of the stock market. I mean, many people have been very critical of Mr. Obama, including myself, but for asset holders, real estate, stocks, bonds, collectibles, he's been a great president. Don't forget, in March 2009, the S&P was at 666, and now we're up to close to 2,300. So this is a fabulous performance. Hardly any other president has had a stock market performing as well as he had. So the stockholders and the capitalists, the asset holders, they really cannot complain about him. They can complain about his policies, but they cannot complain about the money printing that happened and about the fact that wealth and income was diverted from a lot of ordinary people to the corporate sector and to the asset holders. Now, under Trump, we have certainly a more friendly business climate. That, I think, is quite clear. But some of his policies are inconsistent with creating much economic well-being. And we have had now a bull market that in March will be 8 years old. So we're in a very mature bull market, and we are, by June 2017, in an 8 years old expansion, which by any standard is a very old expansion. So where, say, President Reagan He was elected in 1980, came into power in 1981. He had tailwinds. Trump has a lot of headwinds.
Let's talk about those headwinds, because many of those headwinds are, in fact, the creations of these artificially low interest rates, the distortion of the global financial markets due to the policies of the Fed, of course, that you've criticized for many, many years. But we also see, Mark, this movement by people who actually invest based upon their politics. So there were many people who just stood on the sidelines, missed out on that massive rally in the S&P 500, 175% increase, and they stood on the sidelines. And now that Mr. Trump, new sheriff, is in office, some of them are thinking, well, now's the time to get into the stock market. Are they wrong? Do you think we're closer to a top than we are seeing? Do we have much upside ahead in your mind in 2017, or are we near a top in the stock market in your mind?
Well, this is a very good question. First of all, it is correct. Between 2009 and recently, a lot of wealthy people had a lot of cash, and they owned properties, and they owned paintings, and they owned whatever. But they were not convinced that the stock market would go up. In fact, I know a lot of wealthy people, including hedge funds, that in 2009 were heavily short the market, when it just took off massively. So what you said is absolutely correct. Many people have missed on the bull market, and now Trump is elected, and they read all this improved optimism, and they rushed into stocks. But we clearly have to see the U.S. stock market, by any standard, is now quite expensive. It's not a bargain. Number two, compared to foreign markets, the U.S. market is very expensive. In other words, the divergence between the U.S. stock market and foreign markets since 2011 is very wide. In other words, if you're bullish about Trump and his policies, in my view, you will find much better bargains in emerging markets, in Europe and in Japan, than in the U.S.
We really do enjoy global markets, and we've participated in some of the big uptrends over the last year. Peru, for example, broke out, some of the South American countries, and of course, Russia also was so cheap, and still really is in some cases. And we've seen Russia really emerge since the fears of these sanctions may be weakening now that President Trump is coming in. What are some countries that you like as we move forward into 2017? I've heard you recently mention India, that you like India. What countries do you have your eye on this year?
Well, basically, you're right. Last year, the three best performing markets were Russia, Brazil, and Kazakhstan. Whether they will be the best performing assets this year, I don't know. But I think in the case of Russia, it is true. Equities are not yet particularly expensive. There's no bubble. There are other markets in the world that haven't done well and gone down. Say, last year, the poor performers were countries like Turkey, a disaster, or Nigeria. Now, I don't think there's a hurry to buy Turkey, but it's a market that has gone down a lot. Asian markets, some of them have performed well, but they're still on valuations relatively inexpensive. Secondly, I think we have to move a little bit away from saying, I like this market, I like that market, and so forth. I think over the last few years, as you know, there has been a huge trend towards indexing. People buy indices. They buy indices in the US,
ETFs,
the S&P, or in Europe, or in Latin America, and so forth. But I believe, since I live here in Asia, there are lots of opportunities in individual stocks, in other words, in active fund management. As you've seen also last year in the US, the FANG stocks, the popular momentum stocks, they didn't do well. Energy did well, and of course, the best performing sector, nobody likes to talk about because they all missed it, were gold mining shares.
You know, we actually, Mark, rode that rally back in February of 2016. We love precious metals. We actually have a what we call PACE. It's an acronym for precious metals for P, A, agriculture, C, commodities, and E, energy. We think those four areas obviously historically have done well in times of panic and crisis and inflation, of course. But I've heard you recently saying that you believe those core areas could really do well, even as we move into President Trump's administration, because he does seem to be so aware of how to use debt, his understanding of leverage. It seems as if that's just that his policies may just bode well for gold and silver, even if stocks also rise.
Yes, I mean, I'm convinced that precious metals over time will go higher. Mr. Trump, no matter what he says, he's actually an interventionist. If the economy weakens now in, say, 2017 or 2018, don't you think that he will also print money? He will beg the Fed to launch QE4.
You know what will be very interesting, though, Mark, will be what will American or what will U.S. investors do if Trump pushes QE4, if he supports QE4? Do you think that they'll go along with it now that three bouts of this obviously have created a large bubble in the stock market? Do you think that the tone towards the Fed and towards intervention, that we're slowly becoming numb to it and that we expect it, and that maybe we'll invest, maybe the reluctance to invest in the stock market in previous times underneath President Obama will change? I'm wondering if you think volume levels on the U.S. stock market, even in the face of a QE4, could begin to surge, because that's been a big problem. Volume's been declining for a long time in the U.S. markets.
I tell you why volumes have been declining. The individual investor is no longer interested in stocks. He lost money after March 2000 in Nasdaq stocks. Then he regained some confidence in 2005, 2006, and got hit very badly in 2007, 2008. Then the market recovered, but he had lost money and he didn't participate. Furthermore, he gradually realized that the stock market is a very rigged game. It is manipulated by the Federal Reserve and other high-frequency traders and so forth. I'm not saying the high-frequency traders manipulate viciously, but the individual investor, by the time he buys something and sells something, it's already moved, so his transaction costs are very high. So they're absent from the stock market. That's why the individuals are no longer active. But the big boys and what is being traded off the board is very high, high-frequency traders. They may move their portfolio 50 times a day, 100 times a day. But the statistics do not show that.
Which sectors? I've heard you recently mention that you do believe energy stocks could do well this year, as well as commodities, agriculture, and in particular fertilizer stocks. Talk to us about why you think those things might see an increase in 2017. What's your thesis there?
Well, basically, agricultural prices have been trending down for the last couple of years. And last year, we saw some major lows in ag prices, and they started to move up. And the difference between, say, precious metals and agricultural commodities is this. And I'm not saying this in a negative way about gold, silver, platinum, but I'm just noticing the difference or highlighting the difference. Say you and I buy gold. We can store it for 100 years and take it out of our safe, since both of us will live 300 years, and still have the same quantity of gold. You cannot store agricultural commodities for very long. They perish, even if the warehouse is perfect. So in other words, agriculture is produced every year. There is necessity for the world to buy these commodities to feed itself. And then there are occasionally surpluses and occasionally shortages. But it's never hoarded like gold, silver, platinum. That is a big difference. And so the price of commodities depends immensely on that particular year's demand and supply. And in the case of agricultural commodities, in general, and there are some exceptions, but in general, the stock is now very low. In other words, the inventory level is low. And if there is a poor crop anywhere, then prices will go up. And so I think that agricultural commodities, risk-reward-wise, are quite attractive this year. How do you play it as an individual investor? That's not so easy, because you can say, okay, let's buy sugar, or let's buy coffee, or let's buy wheat, corn, soybeans. The problem is that the individual investor, he would have to open a commodities account. With the commodities account, he has to roll over his contract every month. So unless the commodity, the underlying, goes up by 30%, he will lose money. It has to move, because there's a future contract premium, the so-called contango. Mm-hmm. And so it's not easy for the individual to make money in commodities. But he can buy plantation stocks, he can buy agricultural companies that own fields and land, he can buy fertilizer stocks. So that is something that I would consider for an individual investor.
You're listening to the voice of Marc Faber. He is a Swiss investor based in Thailand, and he is also the publisher of the Gloom, Boom, and Doom Report newsletter. He's talking to us via his office in Thailand. There's a lot of changes going on, Mark, in our final moments here. There's a lot of changes happening in Asia. Yes. Of course, the new trade-free zones and all of this that are happening, the free trade zones. What do you see as we go forward with Asia? Do you see complications with Trump? Do you see problems? Do you see war? Or do you believe that much of this is just simply posturing and we're going to see more U.S.-China integration underneath the Trump era?
I think a lot of it is bluff. He appointed Navarro as, I think, in charge of negotiations with China about trade and so forth. Mm-hmm. He's quite an ignorant character. He wrote a book, I think, 12 years ago, which has very little substance and was completely wrong. Predicted at that time that China would collapse. Hasn't happened yet. GDP, in the meantime, is probably up 3 times, and GDP per capita an equal amount. So he's anti-China to start with. But I think eventually Trump, and especially Wilbur Ross, will understand that for the U.S., China is very important in terms of supplying goods at low prices. You understand? No more goods from China. The price level for goods in America that are sold will go up, in my opinion, by at least 10-20%. So then inflation catches up, and instead of making America great again, as has happened in the last 20-30 years, inflation-adjusted incomes will go down further. So you don't create prosperity. And this is the big thing about Trump. Will he create prosperity for corporate entities, for corporations, or will he create indeed prosperity for everyone? For everyone, I very much doubt the way he described it and the way he got the votes. That I very much doubt. And I think this euphoria about Trump and higher growth rates in the U.S., in my opinion, is completely misplaced.
Very interesting. Well, in our final moments, Mark, I would love for you just to briefly explain your investment philosophy, because you're known as a contrarian investor, whether you like it or not. Many people refer to you as a contrarian investor. And for many of our new investors in the audience, they may not even know what that is. Would you just briefly, just in our final moments, just explain your investment philosophy? You're certainly a renowned economist. You studied at the University of Zurich. You have a PhD in economics. You have been investing for a very long time, and you have a very unique style, the way you go about it. Would you just, in our final moments, just explain that style, that investing style, for many of our new investor listeners?
Well, basically, a contrarian, he is a realist. In other words, when people are very bullish, he's a skeptic. Then he questions, is this optimism justified? And when people are very pessimistic, he says to himself, is this pessimism justified, or have asset markets adjusted to the negative view of the market participants? So in other words, you're looking for assets that are either hated or neglected. I prefer to look at assets that are neglected, because when they're hated, you have a lot of contrarians coming in anyway. And being hated doesn't mean that the price can immediately go up. It may go rebound and then drift again. But say if you have an asset class that is neglected and has moved for years, and in commodity markets we had in the 80s and 90s commodities, they fell after 1980 and were depressed for, say, 20 years. So they were very, very low, and suddenly the interest picks up and then prices go up a lot. And same for stocks. There are stocks, if you look at charts, you will see some stocks, they drop, and then for maybe 10, 20 years they move sideways, they build a base, they move from what we call weak hands into strong hands that are willing to hold and buy more, and so then the upside is very pronounced and a sustainable upside. The essence of a contrarian is basically to look at neglected areas, at unpopular investment scenes. Say, what was popular in year 99-2000? High-tech, telecommunication, media. What collapsed after 2000 were these sectors. What was unpopular in 99-2000 were basically gold shares, silver, platinum, and commodities in general, because they had been moving down for 20 years. So the contrarian, he looks at these opportunities in sectors of the investment markets that are not popular. Nowadays, you see, the problem is everybody thinks about being a contrarian and this and that, and there are so many different views because of social media. Everybody has a view, and then so it's difficult to find really a sector that is depressed and unpopular and completely neglected. I believe, compared to, say, 1980 to 1982, when asset markets were extremely depressed, both for real estate, stocks, and bonds. Don't forget, 1981, the peak in interest rates on the 10-year Treasury note was 15.84%. Now, asset markets, all of them are no longer depressed, but all are massively inflated. So as a contrarian, you may say, well, maybe I shouldn't invest at all. But as you pointed out before, and as I think, there's a huge risk for someone to say, I'm going to liquidate everything and sit 100% in cash, because that cash could lose value through currency fluctuations or through negative real interest rates and so forth and so on. So as a contrarian, I say maybe now is a time, we're all on the Titanic. We're all going to suffer one way or the other because we had it so good since 1980. Let's diversify and hope for the best. So I would hold some real estate. I would own some stocks. I would own some bonds. and cash, and I would own some precious metals. With that, you're not going to make a lot of money, out of question. But you may have money in 1, 2, 3, 5, 10 years when other people have lost everything they had. And so with that money, you would be relatively in a good position. And this is my contrarian bet. My contrarian bet is nowadays, with the changes that are occurring in the world and also the political changes in Europe and the US, and with markets being manipulated by central banks and a coordinated manipulation, we just don't know how the world will look in 5 years' time. So I said to myself, I want to be diversified.
Words of wisdom from Marc Faber, an investor based in Thailand. He is the publisher of the Gloom, Boom, and Doom report. Marc, in our final moments here, if you just tell our audience how they can learn more about you and about your newsletter. What's that newsletter all about?
They can Google my name, or they can go on the website gloomboomdoom.com, and they can listen to your interview. Thank you very much.
Thank you, Marc. I appreciate your time. God bless you.
Bye-bye. Take care.
Hi friends, Jerry Robinson here from Follow the Money Weekly. According to a recent study, nearly 1 out of 3 Americans has no financial plan. Perhaps even more shocking, approximately 43% of Americans have never spoken to anyone about retirement planning. For most Americans, the problem isn't that they don't want to protect their family's financial future, but instead, it's that they lack the time to sit down and do the research to find a financial advisor that they feel that they can trust. That's why many years ago, I created the Christian Financial Advisor Network. The Christian Financial Advisor Network, or CFAN for short, is a nationwide network of faith-based financial advisors who fully understand and adhere to FTM Daily's powerful wealth-building philosophies, including our own 5 levels of financial freedom. When you contact the Christian Financial Advisor Network, one of our faith-based financial advisors will reach out to you within 72 hours and will provide you with a 100% free consultation. Whether you need specific investment advice, help with your retirement plan, or simply just have a question about your finances, the Christian Financial Advisor Network is here to assist you. With America's gargantuan debt crisis looming, isn't it time that you sat down with a trusted financial advisor to develop a blueprint for protecting your retirement nest egg, your family, and your financial security? Don't put off planning for your financial future any longer. Take the first step by logging on to ftmdaily.com/advice. If your goal is to achieve true financial independence, get started now by requesting a completely free consultation with a financial advisor in your area right now online. Simply go to ftmdaily.com/advice.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Hello, this is Tom Cloud with this week's Precious Metals Market Update. It's been quite a week for me personally, as I had the opportunity to have 3 of the most important meetings I've ever had in my career. One with a billionaire, one with a money manager that manages a little under $1 billion, and a meeting with a business owner of a gold and silver company in Singapore, one of the largest in Singapore. It was just an incredible last 7 days since we last met. So I want to talk a few things about that and get out of here pretty quick today. Number one, in Singapore, we're just seeing the volume swell up, and we're seeing that money is moving to Asia just like you read about and hear about. Some people don't want to believe it, to the point that today as I talk to you, 8% of the world's gold in value and physical is in the United States. 32% is in India, one country. So the United States is lagging behind. Therefore, we're now seeing, and what he's saying, the growing thing is Asians want gram products. We never converted to the new metric system, and now it's hurting us because if you can buy a 10-gram bar of gold, which is 1/3 of an ounce, you're going to have a lot more buyers in a universe that's trying to diversify and buy a hard asset and protect their assets. So one big change we're going to see the next few years is going to be gram products, 1 ounce, 1 gram, 5 gram, 10 gram products. And once again, it takes 32.15 grams to equal an ounce. So someday we may see people buying our stuff that we own and actually melting it down and turning it into a gram product as demand in Asia just continues to go crazy. And that is the site. The gentleman compared it. He was in New York. He's been in Asia for 14 years. And he was in New York for years before that. But he compares it to the race of 1980 when inflation was hitting, Jimmy Carter was president, interest rates were skyrocketing, and Americans for the first time were learning about gold because they'd only been able to own it since 1972. So it was only an 8-year product, and most people had not been in it at that point. So what he's saying now in Asia, we're seeing the same thing, and that's going to grow and grow and grow because of the number of people they have in Asia. We have 330 million, and you just add Japan, India, and China together have 2.7 billion people of the 6.5 billion people on the planet Earth. So watch demand go. Watch that. We're going to see more and more people storing for the other big story out of this on all three of them. The billionaire, the money manager, and the owner of the company is we're going to see more and more people wanting assets that are not paper. Just think one day you wake up and the stock market crashes. We know the bond market is going to crash. And what do you own? You own a piece of paper, literally a piece of paper. Think about it. You want investments that are physical. You can sell anywhere in the world, has liquidity, has thousands of years of being money, where paper money has a few years since 1913. So what you want to do is be sure whether you have the metal physically in your home safe or use one of our storage programs at Cloud Hard Asset Storage. And if you don't know about that, call us and we will email you an electronic brochure. We have the lowest storage rates in the world on a COMEX warehouse. We can explain all that to you. So you got to realize what these people are asking me, billionaires and money managers, are, tell me the ways my clients can own physical gold and really have it, really own it. Tell me about, I know they can take delivery. I know there are storage facilities. Where are they and how much they cost to store per year? And we stand here to say to you, this is growing and it's going to continue to grow because wealthy people are not going to be caught when there's the next round of equity crashes. I don't know when that'll be. No one does. That's the reason you put not all of your portfolio into several different items. We've talked about that many times. It even says in Ecclesiastes 11:2 to diversify your assets 7 or 8 ways because no man knows what disaster will come upon the land. So this is age-old, and we know that wisdom comes from a multitude of counselors. So we're just here to help you in one area, but in my opinion, it's the most important area for the next decade is having physical metal in your possession or there and an asset that can be liquidated anywhere in the world, and will probably help you set up in one of the venues out of the country where you can have part of it there and part of it in a facility in North America. But anyway, we wanted to talk about that. We still are seeing that the rotation out of bonds, securitized debt, is continuing to happen, and it will benefit stocks and it will benefit precious metals, gold and silver, because we even see now advertisements for using gold as a fixed income product. Say you had $100,000 in bonds and you were making 0.75%, but the bond was going down 10% a year like it has in the last 2.5 months. So you have a $90,000 worth of that and you're only getting paid 0.75% in interest per year. Why not buy the $100,000 in gold when you need it a year later? You say you liquidate enough and just take off what you made and leave the same value. In 2007 16, that would have been 8%, and your cost of getting in and out would have been roughly 3%. So you would have made 5% and still had $100,000 in gold, and you took out 5%. So this is what people are going to do. They're going to manage their gold as a fixed income product. And when I say they're going to, some of this money manager is already doing it. He's already using gold as a fixed income product. So we've got to look out there and realize times are changing. Trump's coming in. We're hoping for a tax decrease in corporate taxes quickly, personal taxes to follow later. So as we go into the year, we're keeping our eye on stocks because we think they will benefit from a Trump presidency, and we think metals will dramatically because of higher inflation, higher growth rate, bigger deficits initially for the first 2 or 3 years under Trump. Yes, bigger deficits than under Obama. So we're in the metals business are looking for a very good year. It's very evident as I record this here on the 18th of January. Gold's already up 4% and silver's already up over 6% in January. So if you need to talk to us, you can reach us at 800-247-2812. That's 800-247-2812. And you can talk to Dan, Scoggins, Kathleen, or myself. If you're interested in a self-directed IRA, we can help you with that and get you a custodian. We can function as your broker and talk about what percentage gold and silver you want in your self-directed precious metals IRA. And we're still believe if you have rare coins, you should also be liquidating those and getting into bullion coins as quickly as possible. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Are you prepared for the next stock market crash? It's not too late to protect yourself and your family with Jerry Robinson's best-selling book, Bankruptcy of Our Nation. Now in a new audiobook format. Whether you want to listen in the car, at the gym, or on your iPad, we've got you covered. Get the entire 300-page book in audio format for only $24.95. That's over 12 hours of Jerry Robinson's economic wisdom, financial insights, and practical money-making strategies for only $24.95. Inside this new audiobook, you'll learn 21 profitable income streams you can create both now and in retirement, along with unique tips on how to inflation-proof your investment portfolio using our own PACE philosophy. And our 5 levels of financial freedom, which is Jerry Robinson's personal blueprint for building true wealth. If your goal is to become a better investor, increase your income, or just understand what is really happening in the global economy, you cannot afford to miss out on the vital information that is jam-packed into this 12-hour audio book. Get instant access to Bankruptcy of Our Nation in audio format right now by going online to www.ftmdaily.com/bankruptcy. That's ftmdaily.com/bankruptcy. Download your copy today and get on the fast track to true wealth and a lifetime of financial security.
I'm Justin Vanderveer with this episode of Income University Minute. If you were to face a budget crisis, could you survive without government assistance? The nation of New Zealand faced a budget shortfall in 1984 and decided to end all agricultural subsidies. This in a nation where agriculture is a key economic component. Did many farmers walk off their land? The answer is no. They adjusted with innovation to the point that it is said most New Zealand farmers would not want government financial assistance in the form of subsidies to return. How about you? If you face a situation where government assistance was not available, how would you cope? How would your family cope? Follow the Money suggests income diversification. Although you are not likely a New Zealand farmer, you may face a similar situation, and FTM wants to assist you with ideas that you can implement. With more Income University Minutes to come, I'm Justin Vanderveer.
All right, friends, and that brings us to the end of our program. Thank you so much for choosing to allow us into your life each and every week right here on this broadcast. And as always, I'd like to leave you with this final word, this time by the Christian theologian C.S. Lewis, when he said, "If you look for truth, you may find comfort in the end. If you look for comfort, you will not get either comfort or truth. Only wishful thinking to begin, and in the end, despair." A good mentor will never stay silent so that you can remain comfortable. Instead, a good mentor will speak the truth in love, because open rebuke is better than secret love. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult